Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kostrup-Larsen.
Welcome back to Top Traders Unplugged, where each week we take the pulse of the markets from the perspective of a rules-based investor. It's Alan Dunne here this week, sitting in for Niels while he's away travelling this week and next week. And today I'm joined by Nick Baltas. Nick, good to see you. How are you doing?
Good to see you, Alan. I'm doing very well. Last day of the quarter and last day of the first half of the year, at least business-wise. So I'm doing well. Trying to keep up with my sleep patterns. We recently had a son, so like the second child in the family. Keeps me busy.
Absolutely. Well, congratulations on your great news. And you're looking pretty fresh. Obviously our listeners can't see you, but I can. You're not looking too bad for a man who's been grappling sleep deprivation. But all going well, is it?
Yeah, I think it's still this honeymoon phase, and it's just 2 weeks now. I think they're still kind of feeling they're in the womb, so they kind of sleep more than they will. At least that's the experience I have for my first one. So let's see how the summer will play out. But for now, so far, so good, I would say. Quite excited.
Great. Well, exciting times, and congrats again. So it's a few weeks since you've been last on. A lot going on in markets, obviously. Anything in particular that's been on your radar or catching your attention in the last while?
I would say on the market side, the interesting move we saw recently was this maybe temporary loss in the carry space. Primarily driven by the Mexican peso unexpected move following those elections. Part of that has been kind of recovered so far, but this was one of the kind of data points we spent some time on. I think beyond that, the market doesn't feel as if it's in a kind of in a worrying state. This morning I actually got like a summary of some stats, just because we're effectively finishing the first half. Just calling a few, since April, for example, mega caps have been up for 24%. Nasdaq is going to be 18% for the full year, and S&P is 35% since October. So I guess in that context, VIX is close to very, very low levels, maybe historical lows. Interest rate volatility is moderating. So it's not that the environment seems to be anti-carry. I think this recent short-term sell-off was something that kind of kept us busy in some respect. Not that we change the view about the shorter term. Is it prudent to take on some hedges on? Maybe, optionality seems to be cheap at the moment. But that is effectively something that we kept ourselves quite busy recently. I should say on the investment side.
Interesting. Yeah. Well, as you say, risk appetite continues to be pretty strong. Equities continue to grind higher. From a trend following perspective, obviously it's the last day of the month and the quarter, so we still have yesterday's returns and today's to feed in. But as of I think close Wednesday, SocGen trend down 2.84% on the month, up 8.5% year to date, and SocGen CTA index down 2.2% on the month, still up a very good 7.09 on the year. Obviously, this month, kind of second half of May and June have been choppy. We've seen reversals across fixed income, grains markets turning down, metals had a run up and then it turned down. So it has been, after a really good start to the year, it has turned choppy and more reversal prone. Any observations yourself on the trend performance?
No, you're absolutely right. So I think the rates reversion that we've seen during the month has obviously, contributed maybe more than half of the underperformance month to date. I think commodities is the other part, as you said, on the grain side. We do get a lot of attention on cocoa. There was another big move yesterday. But suffices to say that the overall exposure to it has been moderated since earlier in the year. Obviously, the reversions recently, alongside the volatility they came along with, reduce some of the overall risk. But it was one of the underperformance. I'm looking now in some of our stats. I think cocoa is maybe the fifth negative contributor within the commodities complex month to date. But we're talking about somewhere between 20 and 30 basis points. That's basically the contribution for like a 15-vol program. On the rate side, almost throughout the markets, irrespective of the tenor or the geographical location, we've seen some significant reversion. Then that effectively maps what we see. The interesting point, and that's something we've discussed quite substantially in the past, is obviously for those months that we see those reversals, is it worth having a reversion components in the strategy? And in this regard, we have actually seen some of our reversion strategies actually helping quite substantially. Up 1.5 months to date, primarily driven actually from commodities. And I think this complementarity from time to time seems to be playing out quite nicely. So this is a good example whereby trend underperformance, for whatever reason it comes along with, can be complemented by some reversion components. So that's the one thing related to trend performance that I would kind of flag.
Interesting. And are you seeing, obviously you touched on reversion doing well in commodities. Is it mapping very closely to the trend markets, or the markets which have trended, such as fixed income that have reversed recently, or as well as commodities?
Yes, in some respect, there is some connectivity in the sense that, if this positive performance comes with some excess upward move, that realizes as kind of very positive skewness in this regard. We've discussed in this show quite a lot of times as to how we think about skewness as a measure of reversion. To the extent that this positive trend materializes as a high positive skewness, then that flags a sell signal from a reversion standpoint. So it's not just a positive trend, but it's more like an exacerbated trend that comes with substantial up moves beyond maybe what normal distribution suggests.
Yeah. Interesting.
I mean, the connection is not 1-for-1.
No, of
but
course.
Somebody
yeah.
can argue like positive skewness typically comes with kind of negative average return and vice versa, if you just think about how statistics operate. So I'm just kind of flagging that part. And also there's another little detail which goes beyond those nuances and relates more to, that's another topic we've discussed, it relates more to thinking about reversion as a cross-sectional dynamic, whereas we think about trend as a time series dynamic. So there's an additional complementarity coming here purely from trying to tap at a different principal component of returns.
Okay, good stuff. Well, we've a lot of interesting topics to get through today, a couple of very interesting papers, and we also have a couple of questions. So we might kick off with the questions first, and then we'll move on to some of the other topics. So the first question that came in was, for many investors, an allocation to trend following is meant to be a diversifier for a beta portfolio, so mainly stocks or bonds, or possibly also golds, commodities, etc. If that is a goal, does it impact the number and type of instruments one should consider in their trend following algorithm? I.e., would you consider a different selection of instruments if the goal is to maximize total portfolio returns rather than getting a return stream uncorrelated to your beta portfolio? So this is obviously a question that comes up quite a lot, in terms of trend following selection, and I think it'll link into one of the papers that we'll look at later. But you must get this as a bit as well in terms of constructing strategies for clients who are obviously using trend in a multi-asset portfolio. So how do you think about it?
I think it has two sub-questions within it. The first one is obviously the number of markets, which I think is the obvious question that comes along with it. Does the number of markets somehow become an important determinant of the overall profile? I think the second question relates more to how does trend following operate when it overlays another portfolio, that being your core SAA, and whether in this regard, the design should be slightly different to running an unconstrained trend following program. I think there is this subtlety over there. So yeah, and that also, as you said, kind of relates to one of the reports we're going to discuss shortly. So on the first part, the number of instruments. On this one, there's a mechanical element and an artistic element. Mechanical element is that obviously the more markets we have, the more diversification we achieve, but the marginal diversification benefit drops. This kind of thing squared over n, the more you add, the marginal gain you get is kind of dropping, even though monotonically it's always increasing. In addition to that, there's a cost consideration. The additional market we add, more often than not, is more expensive to trade than the one before. just because it happens that, we end up adding more, exotic or new markets or niche markets. So then I would kind of paraphrase the question along the lines of, should the cost contribution align with performance contribution or diversification contribution? I think on the performance contribution is very hard to make a cut because then we enter the territory of data mining. I think I've discussed with Niels recently the fact that cocoa historically has been the worst contributor up until it wasn't. And I think purely on that basis, we would not want to choose markets on the basis of contributing performance or not contributing performance. And I think there's this, the prevalence of diversification here is higher than just contribution or return. That's number one. And I guess number two, again, on the same topic of the number of markets, I think about trend following in the following two ways of getting performance. It gets performance from capturing principal component moves. I'm net long equities, I'm net long commodities, I'm net short bonds, whatever that might be. But then there is this fine adjustment on top, whereby you have the cross-sectional differences between those markets. So then the question becomes, should you just go and buy or allocate into a single market in equities, I don't know, S&P 500, and maybe global ag for treasuries, and maybe GSCI or Beacon for commodities? Would that give you a simplified trend follower? Yes, maybe. But we know that when the turning point comes, diversification would play at your benefit. So I think the artistic part in my answer is that there is no right number, at least to me. And we do get, to your point, we do get questions. Oh, should I do it with 40 markets or 50 markets or 100 markets or 150 markets? You would not necessarily see substantial differences between those implementations, partly because if I condense my universe and I need the same volatility overall, I would have to gross up whatever I'm left with to be able to get to that level of vol. I would need to deploy the risk I would otherwise deploy elsewhere. And therefore, it's not just the marginal benefit, but it's also the substitution element we have to think about. I think I'm becoming too technical here, but taking one market out, it's not an act in isolation. It has implications as to how I distribute the risk I would have otherwise taken. And I think that's the complication here that we have to be cognizant of. It's not that all those 10 markets do the job, let's scrap all the rest, because scrapping all the rest will make those 10 reposition themselves in their relative strength. So I think a number that would make sense is, to me, a number that makes a portfolio diversified enough. Whether that is 50 or 80 or 100, that's the ballpark. If somebody were to say, I'm going to use 10 markets, maybe that's on the more constrained side. I would not say that the backtest would look too different. I would just be a bit more cautious on the selection.
Yeah. In relation to the markets, obviously, as you say, you could just trade the kind of the major macro markets, and there's a good reason for that. Obviously, trend following gets returned from kind of macro moves and then kind of idiosyncratic moves, but also from the perspective of the kind of crisis alpha characteristic, in that when there is an economic crisis or a market crisis, those markets will tend to move. Whereas I guess the more niche idiosyncratic alternative markets may be more influenced by idiosyncratic factors. So would you concur with that? So would that be a reason for, in the context of a multi-asset portfolio, tilting more to macro markets or not?
I agree with the fact that the less correlated the universe is, the more diversification and benefits you get from the additional market. We look at it, for example, from a more alternative commodities perspective. These are markets that are primarily driven by producer and consumer dynamics, and there's not as much speculation as there is in the more kind of traditional markets in this regard. So the cross-dependence between them is much less, and the addition of another market, it's almost as if you're adding another dimension of performance. And then I feel like it almost becomes more explicit what's the value out of each and every market. So yes, I would look at it from that perspective, actually.
Yeah. I know, the classic question that comes up in this context is, should you trade equities within your trend portfolio? But we're going to talk about a whole paper around that in a little bit. So we'll hold off on that topic for a moment. The other question, which isn't asked specifically, but maybe is hinted at, and I'll ask it anyway, is then around speed. So obviously that's the other consideration that comes into play when you're using trend within the context of multi-asset. Does that impact your speed? What's your thoughts on that?
I think a central point of consideration typically, and I think it also relates to the second part of this first question, which relates to how should we consider the selection of markets in terms of maximizing returns or looking into an uncorrelated stream of returns to our beta portfolio. Right, that was the second part. So, the speed here, all else being equal, is going to reduce correlation to the beta portfolio, because it basically says, if my speed is 10 years, I would be pretty much long the markets that over the longer term are compensated by holding them. So I would be more or less net long equities, more or less net long bonds. Okay? And obviously the correlation that I would have with the 60-40 is relatively high. Now, the shorter the window becomes, the more reactive the portfolio would be to turning the corner if those markets sell off in the very short term. So one way of reducing that correlation to the beta portfolio is actually from reducing the speed. Now, is that speed reduction at our benefit when we put those together? Of course it is, because precisely the ability of being faster allows us to protect the portfolio in a turning point, right? So you're absolutely right. I think the speed is an important consideration. Obviously, we should be very cognizant of the fact that there comes a point whereby excess turnover and false positives go beyond the benefit we're actually achieving by being reactive. So there comes a point whereby, yes, maybe you are more reactive, but you're now paying too much cost to it. All right. So, to me, there is no sweet spot, but there is maybe there's a range of speeds that are balancing out reactivity, false positives, and costs. Maybe somewhere between 1/3 months to maybe 9 to 12 months. I'm not even making that comment with high level of sophistication. It's more, I would say, heuristics and experience over the years. Now, I think the other point on this complementarity to the beta portfolio is the ability to have or cap some of that equity exposure, which we're going to discuss at length later on. I think to me, this is an important consideration because it is going to help the decorrelation to the beta portfolio, but it's not necessarily going to maximize the total portfolio returns. Even though I have a feeling, and that's again a gut feeling, that some form of moderate equity exposure on the upside will help with preservation of capital in a downturn, and therefore maybe not maximizing the average returns, but I think that geometrically it would. Right? So, but I think we're going to touch upon that.
We will, yeah.
Later on.
So there's a fair bit of more to talk about, but maybe we'll hold off, and anything we haven't captured so far will, I think, get addressed as we talk about the paper later on. So the second question then is kind of a more general question around volatility, and it's from a listener saying, I was listening to the last TTU podcast with Rob Carver. He mentioned he targets 10% volatility in his own portfolio. He owns equities plus some of his own strategies like trend, carry, mean, reversion, and the listener says 10% seem quite low. Obviously, at some point, volatility becomes dangerous, even with a very diversified portfolio. So the question is there a rule of thumb as to what level of volatility starts to put an investor in a danger zone, whereby a catastrophic loss of capital becomes statistically significant enough to at least give pause for deeper thought on whether the risk justifies the extra return? So yeah, what level of vol starts to become too problematic in terms of risk of ruin, I guess. What are your thoughts on that?
Let me give a call to Rob. It's exactly what
yeah, exactly. We won't comment on Rob's portfolio, but it's kind of stemming from his comments, a general question.
No, on a more serious note, and it's clear I won't have an answer, not because I would not want to have an answer, because I think it's hard to have an answer in a question as to what is the right level of vol. The one thing I'm going to say is the following. Let's go back to Markovits. Markovits said that, there is a frontier whereby you get rewarded in the maximal way for the level of risk you're happy to take. And there's this concept of risk aversion that puts you, not you, Alan, you, whoever, myself, in this x-axis, what is the volatility that we're happy to sustain, given the risk aversion we come along with, to suggest what is the return we can achieve. But I would also say that sometimes when it comes to investments, and effectively when it comes to managing liabilities and, assuming, being an asset owner, having to pay, if you like, pensions, or having to pay insurance claims and so on and so forth, they come in nominal terms, right? They come in dollar value. They don't come in Sharpe ratios. So, having a return target, that in itself suggests running a portfolio at a certain level of vol implied by the implicit Sharpe ratio. So there is how we can balance the risk aversion that we come along with the return target we would want to achieve. Or conversely, and that's, I think, the gist of the question, what level of depth is long enough or deep enough for us not to being able to recover from it? And I think it's no surprise that when we look into some of those target-dated funds, they basically say, well, you have to moderate the amount of equities you're holding as time goes by. Precisely because you would want to make sure that you can finance your retirement, and therefore the closer you are to it, the more fixed income you should hold, or the more, safer and quality stocks. So what is a reasonable level? I would maybe respond by saying that we look at mandates with our clients and investors that can have a volatility that ranges anywhere from like 5 to 15, maybe, without those being hard levels. Of course, there are some sort of income mandates that would look into lower levels of all, but purely because this is driven by an income appetite, where the income appetite will go hand in hand with whatever yield is elsewhere available. But, looking into the complementarity of trend following on a 60-40 portfolio, or a generic policy portfolio, I don't think that a 5% vol will move the needle. Having said that, to the extent there is leverage involved, somebody can make a 5-vol portfolio 15%, but just tripling the exposure. So then it's more about leverage considerations that become more important than absolute level of vol. So I don't know if I'm answering the question. I'm just giving ideas around it, right?
Couple of things. I think what he's getting at as well is maybe from a couple of things. Like, as you touched on leverage, so I think that's an important point, and the issues around how you get your leverage, and so we might talk about that. But separately, is there, say from a pure statistical perspective, there are various rule of thumbs that, say if you're running a 10-vol program, you should expect a 20% drawdown over time. That's kind of, say, a rule of thumb. But so then, and obviously it's hard to say with precision because it's the returns are going to be non-normal. Obviously, if it was a normal distribution, you would say for a certain level of volatility, here is the kind of range of outcomes that you can say.
Yeah, we can work it out, exactly.
But obviously, so from that perspective, if somebody said to you, we're risk neutral, intergenerational, long-term wealth, we want to run it as fast, as aggressive as we can in terms of all. I suppose the question I think he's getting at is there a level you would say, okay, 20 vol is okay, you'll have some chunky drawdowns, but you'll probably still survive, but I wouldn't go to 30 vol, or is there kind of a statistical answer from that perspective?
I think to your point, as long as we assume, IID, and we know that trend following is not necessarily following that process. Specifically, if you start looking into medium-term returns that we have this kind of positive skewness, I don't think I'm going to give an answer now which is statistical or econometric enough, but I would say somewhere between 10 and 15.
A lot of trend programs run at a higher level than that. Is that, say if you're a 20 vol program.
Exactly. But the point here is that, I guess the question is, are we looking at that in isolation or as a complement to?
No, that's true. Yeah.
Right. And I think that the 10 to 15, it's more about, looking at it in isolation. I think the 20 alongside the SAA is pretty much matching the vol of equities, right? Not today, but over the longer term, if anything, right?
A little bit higher, but yeah.
Maybe drawdown of a vol, which is a statistic, we would typically look at. To the extent that this historically remains below 2, that's something I would typically look at, even though I tend to dislike drawdown as a measure, but that's a different conversation.
I suppose this is relevant, in terms of things like levered ETFs, like a 2x version of the S&P 500. What kind of drawdown should you expect for something like that, or would you ultimately could you get wiped out? The equities fell 89% in after the crash, I think, in 1929, 1930. So that would suggest that is too much. But but you think in terms of the overall portfolio, probably matching equity vol would be as aggressive as you'd want to go, 15%.
I mean, with my level of risk aversion,
Yeah,
I'm basically putting down the subjectivity in the matter.
I hear you. Yeah. Okay. Well, thanks for the questions, and let's move on. So the first paper is a paper from our friends at Quantica, who have always been a good source of material and content for this discussion here on Top Traders Unplugged. And the paper is Negative Crisis Beta and the Hidden Market Timing Ability of Trend Following CTAs. So quite an interesting paper, I thought. What was it? Do you want to give a summary of it and maybe give your takeaways?
Yeah, absolutely. I think I've been quite vocal as to how much I like the reports Quantica is putting out on a quarterly basis. I'm glad I'm again the person to kind of go through those. So the paper touches on a very interesting point. I'm not sure how much of that is, I guess, related to this year's performance. I think it's been motivated by that because maybe this year is a prime example whereby equities are contributing so much to a trend following program, but also the deviation or the dispersion of outcomes between unconstrained equity programs and very constrained equity programs has been the widest. Said differently, had we not had equity exposure in our trend following program, this year maybe would be flat-ish. I can look into some of the stats, but they have been contributing. Actually, I can maybe look into the overall contribution if I have it here. Year to date. Yeah, exactly. So year to date, if I look into at least some of the trend following strategies we have, equities is by far the best contributor. Second being commodities. Okay, so and obviously we know that rates has not actually held. It was flat until the beginning of this month, and obviously this month have been driving the underperformance. Anyway, going back to the point they are making as an introductory statement is that the rolling correlation or the rolling beta of a trend following strategy, in this particular case, the SocGen Trend Index, is now at around 0.4, which is pretty high and almost closer to the higher levels we have seen for some time. And obviously the point that is made is, what is the value of equities in a trend following strategy? Not just over the longer term, but conditional upon having a down move. And what is this crisis alpha at the end of the day? How can we could potentially quantify it? Maybe under the lens of the equity participation in the trend following strategy. And is it the fact that, being able to go short equities in a downturn, the primary reason why we outperform? Is it a crisis beta? And what is the crisis alpha? And how different variations of trend following with or without equities or capped equities, if you like, rank performance-wise versus an unconstrained program. That's the whole idea. And if you like their conclusion, we can have a conversation as to whether I agree 100%, just to make it a bit more interesting as a conversation. Their conclusion is, yes, capping the equity exposure can help you in a downturn, but over the longer term, the price to pay from this reduced participation on the upside is significantly higher. So you'd rather run your program in an unconstrained fashion. That's basically the summary, right? And we can go through some of the analysis, which I find quite interesting. Before going to the analysis, the one thing I would flag, and I think it's been discussed quite a few times, and I find it very, very interesting as a data point, is that this year is a good example whereby trend following does deliver good performance because it's capturing equities, but the overall market is in a rising mode. So this concept of like trend following only doing badly if things go south seems that this year is an example that this is not actually the case, right? So anyway, going to, I guess, the gist of the report of the paper, basically what they look at, just to motivate the whole story, is to say, well, let's go back to 2000. You have had since then 97 quarters. Let's call it 100 quarters from in this century, and they break that down between the bottom 16%, as in more than 1 sigma quarters, the best quarters, as in the above 1 sigma, and everything in the middle. That's pretty much 16 bad, 16 good, and whatever else is left is like kind of normal regimes. And obviously, S&P and equities have a monotonic increase of underperformance, okay performance, great performance, but then what do trend followers do? And if you look at the return pattern, they are substantially better performance-wise if you were to look at the down periods. So when equities are down, CTAs are performing really well. And unsurprisingly, their correlation or the beta of trend followers in those quarters has historically been negative. So not only do you short the market to make money in a down market, but that leads to an overall positive return that could or not be driven by just that beta. So then they go one step further and say, okay, how about I try to run a regression in those quarters and try to isolate what is my beta to S&P and what's this alpha that is left. And splitting the two, as in what's the contribution of a trend following strategy in a down market that comes from the beta to the market, which is more often than not negative, and what's the alpha. And what they basically find, they list the 16 quarters that I mentioned as being the worst quarters in S&P for the last 24 years. They do find that, no surprise that, again, CTAs are doing specifically well in those quarters, except maybe 3 or 4 from what I can see here. I know they have the stats exactly. So 12 out of 16 CTAs have had good performance, as in positive performance, which is primarily driven by this alpha factor. So there is more than just a beta to the market. And I think that's where bonds come along. That's where commodities come along. Like other asset classes actually performing in those market regimes. But there's also a beta component to S&P. Subtlety, the beta to S&P and the beta to equities, that being negative in a down market, it's not necessarily always driven by the equity participation. It can be other stuff that creates this kind of negative beta. But their point is, look, CTAs do well in a down market because they have negative exposure to equities, but also there is more stuff. And that other stuff is bringing the diversification, the value in a down market. Another subtlety, but there's no point kind of going too much deep into it, obviously running a regression at the end of the quarter, assuming everything is static throughout the quarter, is an assumption that things are staying kind of constant. But for the benefit of having this, this descriptive analysis of performance, it's good enough. I'm just flagging that part, right? So conditional upon this result that says in down market regimes, you do get beta participation on the negative side from equities, which delivers positive return, but also you get some alpha. Should we rethink how we build a trend following strategy in terms of equity participation? And then they say, there is a variety of ways somebody can do that, but they say, how about we try 3 different variations of a trend following strategy? And they say, number 1, take equities out. If there is truly some alpha from the rest, you don't need equities at all. Case number 2, constrain your exposure to equities to only allow them to go short. In other words, in rising equity markets, do not deploy risk. In falling equity markets, do deploy risk. So you're only allowed to short equities, conditioned upon having a negative signal. And I guess the implicit motivation here is to say, well, I don't want to be equities long at the end of 2018, at the end of 2017, because VIX is going to crash the markets and I'll be long markets before I end up realizing that I have to go short. So avoid the positives. And then the third approach is to say, let me get a beta of my portfolio to S&P and then implicitly introduce a short exposure in S&P futures to overall neutralize the beta of my portfolio on an ex-ante basis. So let's assume today we run a regression over the last X number of days or months. We have a beta of 0.5 to S&P. Let's basically go short that number of contracts to make that negative 0.5 in aggregate equal to 0. That's the ex-ante kind of, if you like, neutralization of beta. There's a subtlety here. Going short equities when the market is going maybe up and has a positive beta might dilute the trend profile because you no longer follow trends here, right? That's another subtlety. So these are the 3 approaches. Just to summarize, no equities, just constraining on the short, or neutralize whatever beta exists in the CTA profile, however it comes along, from equities, commodities, bonds, whatever, with a short S&P exposure. And then run the same analysis, looking through the bad equity regimes and understanding which one of those three variations versus fully unconstrained is bringing value. So the result is not surprising to me. It's actually quite similar to some of the stuff we have seen with the research that we do. If you don't hold equities, you still do well in bad equity regimes because you have the other stuff, the crisis alpha I mentioned earlier on, but not as much as you would do with an unconstrained trend. So you're missing this beta component, the negative beta component to equities. If you have a short-only trend following strategy, you outperform the down market by nature because you're not getting hit in a turning point. And when you beta constrain your portfolio, you're also outperforming in the down regime. However, so the first result is forget about not having equities because that doesn't even help you on the downside. But constraining equities either at the exposure level or at the beta level allows you to outperform an unconstrained program. Just to put some numbers, just because I have it in front of me, right? The average quarter out of those worst 16 quarters was negative 9.5% for S&P versus an unconstrained trend of 4.1. Having no equities reduces that to 3.7, but capping equities either by beta or by exposure increases the 4.1 to 4.6 or 4.5, just to give a sense. So you have a performance penalty if you don't have equities, you have a performance benefit if you cap your equities. The problem is that if we look over the longer term, what is the consequence of those decision choices is that the overall trend following performance drops. So the long-term performance of trend followers for those 24 years that they run the analysis would be 5.9, which however drops to about 4% for the capped versions, equity exposure or equity beta exposure. So they make the case that you might be earning about 50 basis points for the level of all around those programs, those stylistic portfolios in the down market, but you're actually paying, quote unquote, about 200 basis points from a long-term performance, right? Which if somebody were to focus just on the bull regimes, which is the flip side of the bear regimes, I mean, I'm looking here at the numbers, is maybe around 100 to 140 basis points. So you lose the participation on the upside because you're short equities or you're not allowed to go long equities for in the reading, smaller benefit on the downside. And they kind of conclude this analysis by effectively saying, look, yes, we can do some things in the implementation to help the downside, but the cost to pay is not commensurate of the benefit. So you'd rather run your thing unconstrained. That's basic. That's the whole paper. And I guess in the grand scheme of things, I do agree a lot with that. You know, we've done a lot of analysis as to how equity participation can be moderated. There are some important decisions to be made, which the paper doesn't go through in detail. Like if you don't deploy equity exposure on the upside, what do you do with that risk? Do you still run, a particular vol level, or somehow you accept the fact that, you're not going to take on some risk? Because taking on that risk elsewhere might increase concentration elsewhere or might create opportunities elsewhere. And, different people have different views.
In terms of construction of their methodology then, obviously they sold some S&P futures to neutralize the equity beta. That was
that's one approach. The other one is that they don't take equity long.
No, I'm just talking about the equity cap bit. So that would probably have dampened the vol. So in theory, I wonder, should they have levered that up, compensate for that to
equally?
Yeah.
Exactly.
A question. I mean, would it? Obviously, you could have neutralized the equity beta in different ways, because obviously you're picking up equity beta in other markets, not just equity. So that may have made an impact too. I mean, the how they've chosen to neutralize the equity beta. Is that fair to say?
Oh, absolutely. So I've seen, I think from memory, there was an AHL paper, maybe 2016 or 17. It has some nice analysis of capping the equity exposure. And from memory, I don't think that the published version of the paper still had that part of the analysis, but I think the working paper still has it. It's a typical thing, editorial. In the editorial phase, some of the stuff, doesn't survive. And they were looking into the beta of a trend following strategy as a look-through calculation. So every single market would have a beta to equities. And obviously, because beta calculation in the portfolio is a linear combination of the single betas, the weighted beta is the portfolio beta, and therefore you can run your program and say, okay, how about I optimize my portfolio and I cap that to 0 or 1 or whatever I want to cap it, right? So rebalance the portfolio so that you end up getting a, 0 beta to equities. I think some of the, and this is just my view, right? It doesn't have to be shared with the industry. Some of the debates I have philosophically, but also practically with such beta constraints in the portfolio design is that you might end up having some position switching that dilutes quite substantially the trend nature of the program. Example, if we're long equities, left, right, and center, and we cap the beta, one possibility is that we would start shorting all those equities or reducing the exposure substantially, and therefore having a design that goes short markets that are appreciating in price. So is that a trend program? I don't know. We can debate. That's number one. Number two is that you might have even a more odd case, that being that instead of you reducing your equities, you start increasing markets that have negative correlation to equities. Example, suppose that equities historically were negatively correlated with bonds. The bond beta, if you were to be long bonds, would be negative. So for you to reduce the overall beta, you can actually increase the exposure to those that have negative beta, right? So then you end up in a situation that not only did you not reduce your equities, but you also increased seemingly negatively correlated markets to equities, and you're now becoming even exposed to a correlation shock afterwards. So imagine both equities and rates falling afterwards because, inflation is spiking. Not only did you not protect your equity side, but you're even overexposed to the bond side. Okay, so I think it's a subtlety that it's worth flagging. Of course, somebody can say, look, I don't want to do beta calculation to all my markets because, then I end up into statistical kind of insignificant territories. Maybe I just constrain the equity beta from my equity participation, from my equity part. So there's a few variations here. Not that this would alleviate the point I made about switching direction, right? So that in itself is also, it has that as well, right? So there's a variety of those. Did I answer your question? Was there a question? I think that was more about. Sorry,
well,
I kind of went
talking about
on
the methodology, but at the start you said you agreed with it broadly, but you didn't 100% agree with the paper.
Yes,
what would you say you don't?
I'll tell you where my disagreement comes. I think my disagreement is not a disagreement in the methodology of the result. I absolutely agree with the results, and we have seen similar results. That basically the price to pay from the lack of participation on the upside is quite substantial, given the benefit you get on the downside. But that does not negate the fact that you actually improve your downside. So then, from a complementarity standpoint, maybe we're paying a long-term premium, which, however, can smooth returns and preserve capital in a down market. And because investors all of us are very asymmetric to gains and losses, right? We're much more sensitive to losing than winning. If you lose $1, you feel worse than winning $1. And maybe one is little enough, but if we make it 100, that becomes even more explicit, right? And this convex and concave behavior that we have between losses and gains is the one that makes us preserve capital on the downside more important than increasing the upside by a basis point or two. So I think this asymmetry here might be enough to compensate us for the lack of, if you like, additional downside return when we pay a premium on the upside, right? So maybe the asymmetry in the result is nothing more than mapping the asymmetry of risk aversion we have on the downside. That's the point I want to make, right?
I agree. And I think it was something I wanted to pick up, because obviously the analysis is framed in terms of quarters. That's kind of the time frame they've analyzed. But obviously, depending on your investor's utility function, they might be very sensitive to monthly returns. So, a lot of this kind of debate was motivated, as you mentioned, about the experience in 2017 when equities were trending heavily higher and trend followers were long, and people were concerned. In some cases, you might have seen CTAs being 150% long equities, and then people have that exposure on top of their core holding, and then they're worried about a reversal. And so a lot of the time we construct analysis in our world, based on long term and risk neutrality. But the reality is, people are risk averse, and for whatever reason, they may want to protect that or soften that monthly P&L. So now, I suppose what the paper does highlight is that the size of the cost is quite high, as you point out. It's only 2%, but for a certain type of investor, you could see how it may still make sense. I guess that's your point, isn't that right?
And I would say this year would have been even more substantial, right? I think the motivation of the paper is very solid in saying, look, had you not had equities this year, you'd be questioning the value out of your trend follower, right? And I think it puts some light into this debate as to how much equity should I hold. And I think that's very, very valid. And I think this year is a very good example when we consider or question the value of equities in trend following programs, because the question comes along. So I fully agree with you on this one. And again, as always, Quantica, super nice.
Very interesting.
Super nice stuff.
I think the other point that they really bring out, and it's the title of the paper actually, is it says, it obviously talks about negative crisis beta, which we've talked about, but it also is called the hidden market timing ability of trend following CTAs. I think that's a really important point, because in the world of finance and investing, market timing nearly has a bad name. Everybody says, "Oh, you can't time the market." It's one of these expressions you hear, which is true in any one situation. But what the paper highlights heavily is CTAs have a very good long-term track record of timing when to have positive and negative equity beta. Isn't that right?
Oh yeah, absolutely. And I think I'll make 2 points. The first one is that timing the market in itself without a context of horizon is an incomplete statement. So if you were to tell me time the market tomorrow, I'll tell you I have 50% chance of getting it right because it's a coin toss. But over the medium term, the serial correlation of returns, or even more so, the clustering of volatility gives rise to predictability. There's actually a very nice piece of work that's an academic paper. Maybe we discussed that in the podcast about a year ago. It basically says you can also have serial correlation in the returns. You can even have trend following behavior and predictability, even if you don't have serial correlation in the returns, as long as volatility clusters. Because when volatility is high and remains high, you're more likely to observe those big moves, and those big moves follow the same direction. So they show mathematically that it's possible that as long as volatility clusters, you can have this return predictability. So the point that I'm trying to make is that over 1 month, over 3 months, over 6 months, the fact that trend following realizes positive skewness as a return series is in itself testament to this market timing capacity, which, however, is not obvious in the very, very short term. And I think that's an important distinction to be made. The second point, I'm going to digress for a second, unless you had something on this particular one. I'll just highlight it without having to go through it. But this, I guess, this difference between building a trend following strategy versus building a momentum strategy. And when I talk about momentum, I'm talking about cross-sectional strategies. I'm buying winners, I'm sorry, losers. The difference between the two was actually studied quite a few years back. I know of this one good paper from Amit Goyal and Jagadish. Obviously, Jagadish was one of the two that came up with the single stock equity momentum 30 years ago. This particular one I'm referring to, I think it's from 2017 or 18. And effectively, the title says cross-sectional and time series tests of return predictability. What's the difference? And all they're saying, and I'm not going to go through all the details, they look into single stocks as well as macro markets like trend following, the typical trend following, we know managed futures. They basically say that the difference between winners and losers vis-a-vis going long appreciating markets, going short depreciating markets is nothing more than, and I'm quoting, time varying net long investment. Which is obvious, right? If more go south than north, I would be net short and vice versa. Whereas a cross-sectional strategy, to the extent it's not beta biased in the ranking, will kind of be market neutral. And there's way more than that in the paper. But I guess to close that I guess long-winded answer, there is market timing capacity which manifests itself in the medium term. I think Katie, maybe 2-3 months ago, if not less, I think it was 2-3 months ago, she was kind of making this point of positive skewness in the medium term, which I think is very, very important when it comes to following strategies. And this market timing mechanism does play out in the downside. That's this. The Quantica paper says there's a crisis beta, and that's the market timing, and there's a crisis alpha, which is all the other stuff from a diversification, multiple asset class, and so on that you get on the downside.
Yeah, no, I think it just that market timing message is important from where we are at the moment, and that's an important point around trend following. It does keep you in the trend, and it's a way of managing your long equity exposure, because by allocating to CTAs, they have that market timing mechanism, so that we don't know when's the right time to get out and scale back our equities. There's so many factors, but if you approach it systematically, CTAs have proven that ability to manage that net equity exposure. So I think that's an important message that's coming out of this. Conscious of time, and we did want to get on to the second paper, and it's on one of your favorite topics. It's on the topic of carry, and it's from the guys at Resolve, who have produced a practitioner's guide to manage futures carry. So from Adam Butler and Andrew Butler. So it's a very comprehensive look at the different types of carry strategies we see in the market. And I did note they referred to your own 2017 paper on carry quite a bit. So you're clearly the man in the know on carry strategies, Nick. So what were your takeaways from this paper?
First of all, flattered to be quoted. So that's humbling, and thanks the guys for doing so. The paper basically says, look, we have trend following, does the job, but how about complementing it with some carry dynamics? So carry, I think it's a term that we use very, very often. The gist of it, what carry really means. I typically use this example of buying a house, getting a mortgage, price is 100, you get a 3% rate, you rent it out for 5%. The difference between the two, as in the benefit you receive from holding it, people in commodities call it convenience yield for the sake of argument, versus the financing cost of owning the place, that being 3%. So the difference between it being 2% is your carry. That's the return you get over the course of a year, with a big if the price stays at 100. Okay? And I think this capital appreciation or capital depreciation, the capital gain appreciation or depreciation, is to some respect the risk that a carry strategy would have. Now, clearly, if the price goes up, happy days, because you get your yield and the price goes up. But the risk is that, if you like, the reduction in price will net off, if not outweigh, the benefit of holding it. In a non-arbitrage world, the two should match each other. If I look into FX carry, a high carry currency, so a high yield currency, should depreciate in price as much as the differential in the yield is to, the dollar or the Swiss franc, right? But we know that covered interest rate parity doesn't hold in this regard, and therefore the FX carry, but also carry in a broader sense, is a source of return that has historically been associated with risk in this regard, whether it's a higher yielding bond, or whether it's a higher dividend yield equity index, or whether it's a commodity with increased convenience yield given the storage costs. Obviously, you have this short supply concerns in this regard. So there's some sort of underlying risk that can justify carry returns. So the paper goes about designing carry strategies, and I think the similarities to the 2017 work is looking into not just the definition of carry in equities, commodities, rates, and FX, but more so into different implementations, and looking into what we call time series implementations that goes closer to a trend following world, because you're buying positively carrying assets and you're shorting negatively carry assets. They look into cross-sectional definitions, which basically says top half, bottom half, I'm going to go long and short the top carry and I'm going to go short the worst carry, but I'm going to be balanced between them. So somehow try to...
Is that, I think, within a sector, is that right?
Correct, within commodities and within equities, within rates, within FX. So somehow try to moderate the exposure to the beta of the market, to the principal component. And then they even go one step further and say, how about I try to optimize the portfolio, and instead of maybe inverse volatility scale my exposures in a cross-asset fashion, I end up using an optimizer, right? So that's the motivation to start with. There's a lot of detail as to how these carry metrics are estimated. The one thing I'm going to say, that thing is off the charts in the sense that, for equities, it's some sort of dividend yield. Maybe somebody can back it out from the futures curve. It's slightly different to looking into historical dividend yield. The latter is more like value, whereas the former is more like the kind of risk-neutral expectation of the dividend payment. That's the subtlety here. On Gavis, it's relatively straightforward. Slope of the curve last the roll down. In commods, we would typically look into neighboring contracts. Maybe there are seasonality considerations here to be taken into account. For currencies, is the forward basis. So the definitions are not contentious by any measure. The one thing I would flag here is that maybe there can be work done even at the signal design phase, specifically for markets, and I think seasonality is one good example, for markets that the curve itself is pricing in a spot move, and therefore any spot move, all else being equal, could be detrimental to a carry portfolio. So, even the carry itself as a measure can require, or I think that's my suggestion. Somebody can spend some time looking into the definition itself, enhancing it in some respect. But subject to having a definition, the one additional thing they do in their design phase is that they look into what they call a Z-score of the carry. What is the Z-score? If today, I don't know, let's take an Australian dollar has a carry versus US dollar of 5%, they transform this 5% by deducting the average carry over the last, let's say, 1 year or 3 years or 5 years, and divide by the vol. So effectively say, how more or less in standard deviation terms is today's carry versus its own history? Is it carrying better than before? Is it carrying worse than before? So that is an additional definition that they use in the design of the portfolios. So to summarize, absolute carry today versus every market's carry versus its own history, standardized by standard deviations historically, right? So the different definitions, I think this kind of reminds me a bit more like in equities when we say this, this particular stock is cheap, or it's cheaper than it was when it used to be, right? So that's the subtlety, right? So they end up building a number of different portfolios, cross-sectional portfolios within each and every asset class, currencies, energies, metals, and bonds, and then they combine them into one portfolio. They do the same thing by using the Z-scores. In other words, which currency is carrying better than itself versus the overall cross-section. I'm going to say that again. Which currency is carrying today better versus its history when compared to all the others versus their respective histories? Right? It's a bit convoluted, but it's almost like a double comparison here. Something versus its history and versus the rest with respect to their own histories. Then they combine everything together, and they do the same thing with a time series definition. It basically says buy positive carry, short negative carry. What's the subtlety? If there's an asset class whereby carry is primarily positive or primarily negative, you'll end up forming beta bets. So when they find that in the cross-sectional definition, they do not observe too much of those correlations to beta markets, it's no surprise that when we do a time series bond implementation of carry, you do have a very high level of beta or correlation to treasuries. I'll just pick it up here. The time series implementation of carry in bonds has a 67% correlation to bonds. Because historically you have upward sloping curves, you have positive carry, positive roll down, and therefore you're going long bonds, however many bonds you have out there. So it's no surprise that you're actually almost softly building a positive portfolio in terms of correlation to bonds, right? But the way the universe they use is actually quite contained and maybe on the smaller side. Just to give a sense, it's 5 currencies, it's 6 energies, 3 metals, 3 bonds, so the bond, the gilt, and the USD, and about how many equities? 1, 2, 3, 4, 5, 6, or 7 equities. So one point that I would make is that obviously cross-sectional portfolios with 3 or 4 markets are actually quite constrained. That's the one point I would make. But beyond that, the results initially suggest that the cross-sectional definitions have been losing steam based on those definitions, based on those universe for the last 5, 6, 7 years, whereas the time series one seemed to favor a bit better. And then they end up building mean variance portfolios and say, well, instead of me ranking things or just going long or short positive or negative carry, how about I just throw my signal, that being my carry, and I maximize that while I'm controlling the overall vol. There's a variety of variations in the design, and they end up, if you like, building time series portfolios across the asset classes with a variety of definitions and optimizations, and ultimately the level of correlation to the beta markets is quite substantially reduced. And one of the points of the paper is to say, well, not only do we manage to reduce overall exposure to those beta markets, but also we try to get an overall performance which is stable through time and has a Sharpe close to 1. However, because of this time series variation, they make a very important point, which I think is key in this analysis. They say, well, maybe the correlation to bonds and equities, for the sake of argument, is 0-ish over the longer term, but is it locally 0? So then once they run rolling correlations, they find that, it can go very positive and very negative through time. So it's time varying. It's like trend following, right? Now, trend following has 0 correlation to equities, but we just discussed that it's very negative on the downside and it's very positive on the upside. So they find similar things when they build a portfolio that follows the sign, if you like, of the carry metric. Can be net long, can be net short. So then they add some constraints in the optimization that controls the beta to equities and treasuries and sets it equal to 0. That is nothing different to what we discussed maybe 10, 15 minutes ago on a look-through beta calculation. Okay? So once they do that, this beta is controlled a bit more, and overall, they end up kind of concluding the paper by saying, look, it's a complementary strategy to trend following. It is not with those controls exposed substantially to treasuries or equities, and there is this complementarity that it can bring alongside trend following in a total portfolio. When you had 50% trend, 50% carry on top of, say, S&P 500 and so on. Some of the comments that I would want to make, if you like, from, I guess, my assessment and my obviously subjective viewpoint, is that a time series implementation of carry, precisely because it can deploy those beta exposures, might at the margin not necessarily go against the carry premise, but might get implicit benefits, not because it's capturing better markets to generate carry if nothing moves, but rather benefiting because something is moving.
Exactly, yeah. I mean, that was the question I had. I mean, presumably that's the classic case of, oil goes into contango in a oversupplied market, so the market's trending down, you're going to tend to be short. Is that's a big source of the return, presumably?
Exactly, right? Exactly. So that's a point that myself, even after the work in 2017, kind of made me think more as to how we should think about carry strategies, specifically not only the context of a carry strategy in isolation, but in the context of having a trend following strategy on the side. What benefit do I get from going long bonds because they have positive carry signal when I'm anyway going long bonds because they have an appreciating price? Which, by the way, is the combination of an accrual in the carry signal and a yield move.
Sure, yeah.
So there's also this aggregation of movement that trend following would capture. So in my world, or at least in my mind, finding ways of minimizing spot contribution, even at the expense of some performance reduction, is not necessarily unwelcome. Because if there are other reasons why carry does well, beyond the fact that you get the kind of roll down and roll up in the futures curve, it might be part of the trend system, right?
Yeah, well, it's more of a kind of a directional signal
Exactly,
as
right.
opposed to being the source of the return itself. Yeah,
exactly right. Now, obviously, they do all this work by neutralizing those betas and so on and so forth. Another subtlety minimizes those betas or controlling those betas, albeit the time series definition they have starts imposing cross-sectionality, right? So, example, I mentioned that already, right? If you're holding all your bonds long because they have positive carry and you want to control your beta to bonds equal to 0, what do? Well, you start shorting half of them, all else being equal, right? So suddenly, I think what they achieve with controlling those betas is a mixture of cross-sectionality imposed into a time series definition, quote unquote, right? And I mean, this is the good and the bad thing about mean variance optimization. It doesn't follow the direction. You can have a positive signal, but you can go short. And that is even without constraints, let alone having constraints in place. Too technical maybe for a Friday and of course, and the first half. But anyway, super good stuff. And from my perspective, I'm as I said, I'm a proponent of carry and other sources of return in addition to trend. I think on the implementation side, I have some views which I think in one way or the other the paper gets to, either explicitly or implicitly. But I do believe that trend following in itself captures beta moves. Carry can further enhance that by adding, to the extent possible, in a neutral fashion to directional moves, the roll up and roll down the curves.
Yeah. Well, I think that's one of the interesting points about, the paper and kind of highlighting the performance characteristics as well, because often when you say, well, we're going to add non-trend strategies to trend, there's an assumption that they all operate like FX carry in terms of being negatively skewed and might enhance the Sharpe, but will blunt the positive convexity characteristics of trend. But that's not the case with respect to commodity carry. So I think that's something that tends to get a little bit overlooked. Yeah. Well, listen, we've gone on quite a bit. We have. A lot more to talk about on carry, I think, on future episodes. But thanks very much, Nick. So next week, I'm back again. Niels is out. I'm back with, I'll be here with Chem next week. So any questions, please send them in. And with that, stay tuned to Top Traders Unplugged, and we'll be back soon.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.